Okay, it looks like we're live now. Yeah, let me just do something. Okay, I think we're live. Okay. Well, hello everyone. Fred Waller here with Waller Tax and Financial Services. Very excited to be delivering this educational webinar. Very excited to be introducing this or delivering this webinar in such an innovative way. We hope that this is something that it's very effective in getting information out to people. I'm telling you now, if you're watching this, then you can feel free to share it with other people, and we hope to be extremely educational. This is our webinar that Kyle and I is doing. It's called Parents, Give Yourself a Raise in 30 Days. And so we're going to be talking about that. And parents, give yourself a raise in 30 days based on using the new tax law to increase your take-home pay. On January 1st, 2018, a new tax law went into effect, and that new tax law had a tremendous impact on parents and their refunds and their tax liabilities. And so we hope to spend a few minutes not just talking about the tax law, but giving you some practical suggestions on what you can do to take advantage of the new tax law and how you can possibly within 30 days give yourself a raise, meaning have more money come home, anywhere from $50, sometimes all the way up to about $200-300 a month. So with that being said, let's go ahead and get started. Our presenters today, of course, myself. For those of you who don't know me, my name is Fred Waller. I own Waller Tax and Financial Services, a full-service tax and financial planning firm. Between Kyle and I, we have over 700 individual and small business tax clients. And I also have a financial planning firm, and I also have an insurance firm as well on the auto and homeowners insurance side. And who's presenting with me today? Kyle McLaughlin. Go ahead and share who he is.
Hello, everyone. Yes, I'm glad to be here with you, Fred, and helping educate our clients. Not for those who don't know me as well, see me in the office. I've been working with Fred as a tax preparer now for 4 years, and I'm actually the specialist in the firm on life insurance. Been doing that now for 11 years. So looking forward to bringing you some educational information over the next few months.
That's awesome. That's awesome. Well, real quick, very short agenda. We hope to not have you on here no longer than about 25 to 30 minutes. Our agenda is simple. We're going to have a real quick video. Then we're going to talk about an overview of some certain parts of the new tax law. Then we're going to have some real life examples, and then some ideas on what to do with your new raise. And then if need be, we're going to have a Q&A. First things first, before we get started, I just want to ask a simple question. For those of you who are on the call, can you all hear and see okay? So I've just sent a poll out. And for those of you who are on the call, can you all hear and see okay? Okay. We have somebody that's saying no. So what we'll do is we'll have our office manager kind of work through that to make sure we get that situated. But all in all, I think we'll be okay. All right. All right. So now we're back to the Q&A. So with that being said, let's go ahead and let's look at the video.
No, I prefer not to. Our parents, we make our parents.
The reason I like it is because it keeps the government going, and the reason I don't like it wastes more of our money.
They throw it at the wall all day and hurt their face, and then they go to the hospital the next day.
No!
They just take extra money that could be going towards me and my dream of having my own personal chef that will just, whenever I say so, just cook me burgers and french fries all day long. It'd be amazing.
Okay, so we just wanted to show the video. We thought that was a neat video just to get it started. You had some young kids there talking about whether or not they like paying taxes or not. Now, none of us like to pay taxes, but we all are legally obligated to pay what we're obligated to pay. But it's our job, Kyle and I's job, is to make sure you legally pay the least amount possible. So with that being said, we're going to start launching into the new tax law changes. And we're going to have Kyle go ahead and spend a few minutes sharing with us that information, and we'll go from there.
All right. So the first thing I just want to get across is some of the new tax brackets that are changing, which is also known as the marginal tax percentages. And so what we've done is laid out the 2017 versus the 2018 tax return. The tax brackets. So you can see some of the changes there. In 17, there was 10, 15, 25%. That's where most of our clients land. If you look at the tax brackets going into 2018, we're still going to keep the 10%, but 15% is going to reduce down to 12%. The 25% tax brackets reducing down to 22%, and those in the 28, it's going to reduce down to 24%. So as you can see, most of you are going to have anywhere between a 3 to 4% reduction in tax brackets. What's that mean? That means more money in your pocket. Next, I want to cover the tax changes when it comes to the standardized deduction. Okay, so not the itemized, but basically the standardized deduction. And so what we've done is break it down between the single filers, married, and head of household. So some of the changes for 2018, the single and married filing separately. Last year, your deduction was $6,350. It is now increasing to $12,000. Those who file married jointly is increasing from $12,700 to $24,000. And lastly, the head of household filers is the standardized deduction is moving from $9,350 to $18,000. Some big changes there. Those young families that have children, huge benefit now going into 2018. Any qualifying child under 17, the deduction is now $2,000 per child. Last year in 2017, it was $1,000. Please keep in mind, though, there is still an income phase-out level, okay? And we listed them below. Single individual is the phase-out starts at $200,000. Those filing married jointly is $400,000. So once again, the qualifying child under 17 deduction is now moving $2,000 per child. Lastly is some of the new tax law changes when it comes to the $500 tax credit for non-child dependent and or dependents over the age of 17, another tax deduction. And with that said, I'm going to turn it over to Fred to give you some real life examples of how these tax changes that I just discussed are going to reflect on your tax return.
Awesome. Thank you so much, Kyle. And just to kind of put an exclamation point, some very, very interesting things going on. Probably the most powerful thing is the child tax credit. So if you're a parent and you have a child, the child tax credit has changed things drastically in terms of whether or not you would be able to give yourself a raise. And if you'll notice, some of the standard deductions have changed dramatically as well, which will also have a major impact on your ability to give yourself a raise. So what I wanted to do was spend a few minutes just kind of looking at some real life examples. So I'm going to take a few seconds and share my screen with you. Okay. All right. Perfect. Okay. Just want to make sure we have everything. All right. So what I'm going to do is I'm going to get rid of my camera so we can just focus in. I wanted to show you this right here. If you'll notice, it says Potential Tax Cuts and Jobs Act Impact. So this is an example of a real life person. You notice I've blocked out the names and the tax ID, but this is an example of a real life person. Here's an example of somebody, if you're single and you have 3 kids, this is an example of what you can do to maybe give yourself a raise. And if you'll notice, one of the first things is this single parent, their standard deduction is going to change from $9,350 to $18,000. That's going to be a plus. And if you notice down here, the child tax credit and the refundable portion of the child tax credit is going to change drastically. So for example, this particular client, their refund last year was $5,360. Under the new tax law, their refund is going to be $6,958. Now, what that means is if this person wanted to give themselves a $200 a month raise, we can show them how to do that. And if you'll notice, what would happen is if you gave yourself a $200 raise, you would be trending towards maybe instead of getting a $6,900 refund, or in this case, $6,958 refund, you can give yourself a $200 raise, bring home about $200 more per month, and still look at maybe a refund of about $4,558. Here's another example. This person is somebody that just has one child, okay? Head of household, one child. Again, head of household standard deduction has changed from $9,350 to $18,000. The child tax credit, in her case, the child tax credit was $300. Under the new tax law, it would be $2,000. And so if you'll notice, her refund was $6,960. Well, under the new tax law, she is looking at potentially an $8,908 refund. So if she wanted to, she can give herself a $300 raise, take $3,600 away from the refund, add $300 a month to her take-home pay, and still end up with a $5,308 refund. And we have a few more examples. This one is an example of a married couple with 2 kids. You notice, remember when Kyle said the standard deduction for married couples were going up? The standard deduction last year was $12,700. Now it's going to be $24,000. And if you'll notice, their child tax credit was $2,000 for their 2 kids. Under the new tax law, that tax credit is going to be $4,000. So that means last year they actually got a refund. Again, these are real clients. They actually got a refund of $3,444. Now the refund would be $5,018. And let's say you don't want to get that aggressive. You don't want to give yourself a $200 or $300 a month raise. This client would have the opportunity of maybe giving themselves a $100 a month raise. And then that would maybe take about $1,200 away from the refund. And they could literally give themselves a $100 raise in 30 days, still end up winning a $3,818 refund. And lastly, this is an example of a married couple with more than 3 kids. Again, standard deduction for a married couple goes from $12,700 to $24,000. The child tax credits and the refundable portion has done some incredible things. And so in this case, this particular client, their actual refund was $6,931. Under the new tax law, they are looking to get a refund of about $10,724. So this particular client, if she wanted to, they could give themselves a $500 a month raise, take $6,000 from the anticipated refund, and still get a refund sometime April or May of $4,724. So again, these are some real life examples that I thought would be really helpful. So what I'm going to do is I'm going to come off of those and go back to the slideshow presentation. And we talked about the real life examples. So what would you do if you wanted to do this? Well, one of the things you would have to do is give yourself a raise by adjusting your W-4. And let me just show you one more screen share. Okay, I'm just wait. There you go. It's launched. So here's the screen share. Perfect. Okay. So all of us have the opportunity to adjust our W-4s. And so if you look right here, you can put your first name, last name, social security number, home address, and you can make some changes here. Maybe you're married to. and you now, in order to give yourself a raise, you change that from married to married for. You can do that and make the change, and then your employer is obligated to withhold less money from you. And so this is how you can give yourself a raise, by adjusting your W-4. So I'm going to come off the screen share now and go back to the Slido presentation. Okay. And so now, as we come to a close, again, we wanted to talk a little bit about what the new tax law is. We wanted to give you some real life examples of what you can potentially do in terms of giving yourself a raise. We spent a few seconds looking at the W-4, in which how you can maybe use the W-4 to make the adjustments so your employer can take less taxes out, so you can subsequently give yourself a raise. Now, one last thing we wanted to do. If you decide to take advantage of this new tax law and give yourself a raise within the next 30 days, we have some suggestions for you on what you might want to consider doing with some of the money. Not all of it, but with some of the money. And so I'm going to have Kyle come back in, because two things we thought would be excellent. One would be purchase a life insurance policy for your child, and Kyle's going to talk about that, and save some money for college using the Enhanced 529 plan. So with that being said, we're going to have Kyle take over from here. Thank you. Got to put your mic on, Kyle. Your mic.
Thanks, Fred. I appreciate it.
Okay.
Just wanted to talk about one of the things that you could do with your raise is to purchase life insurance policy for your child. It's one of the most important things to have to financially protect yourself. A lot of people ask me, why should I buy life insurance on my child? And it's really to financially protect you. And I always start off with telling this story. I had this past week, I had met with a lady that had life insurance on her son and wanted to purchase more life insurance now that he was getting older. But unfortunately, in those years, the child had developed an early onset of type 1 diabetes. And unfortunately, because of that diagnosis, we were unable to write him additional life insurance. So that is extremely important, to purchase life insurance on your child as soon as you can, or as early as possible, because you really financially protect yourself and you're protecting the insurability of your child. So what I've done is just broke down 4 things why it's important to purchase life insurance. First one, like I discussed, it gives you time and the resources to grieve. Let's face it, most of us don't have a lot of sick time or paid time off to take off work to grieve for your child. A lot of us don't have $10,000 to $15,000 just sitting in a bank account to pay for a funeral. And even if you wanted to use that money and take money out of your 401k or from an IRA account, it's not a very sound financial decision to pull a lump sum from your 401k, because it's going to cause some tax ramifications. So having life insurance will give you the time and resources to grieve. Number 2, huge benefit here, it provides cash value and living benefits. And what I mean by that is a lot of your whole life policies and universal life policies build what's called a cash value that you can withdraw or borrow against, that can be used for your child's college tuition and expenses. It can be used to finance a vehicle. It could be used to pay for a wedding. They're not cheap anymore. And they can even be used as a collateral for loans primarily. Number 3, one of the things you're doing is you're protecting their insurability. So therefore, they're always be insured. Nowadays, the children are getting diagnosed with high blood pressure, diabetes, obesity, cancer. These are just to name a few health complications that might prevent your child from being insured down the road. So the earlier you can do it, regardless of future health, they are insured, they already have life insurance, and you have fixed premiums. And number 4, probably one of the things I strive on is saving you money, and I hope you are too. So once again, as soon as you can set up a policy for your child, you are locking in the rate. Okay, so it's extremely affordable. It's the cheapest that you'll ever buy a policy for your child, because if you're at 0, that's the lowest you can buy it. It gives you the opportunity to lock in that rate as early as possible. So those are the top 4 things that I would say why it's so important to have insurance on your children. And, you know, a life insurance professional like myself can help you select the right policy, the type, the optional riders for your child to really get the most out of your policy, even when he or she is grown with their own family. So I hope you enjoyed that. Let me know if you have any questions when it comes to why it's so important to have life insurance on your children.
Hey, Kyle, thank you so much. Great information. And again, what we're trying to accomplish here is to give you some suggestions on, as parents, now that you know that you can within 30 days give yourself a raise, what are some things you might want to think about doing with it? Kyle makes some very powerful points about the importance of getting life insurance. Hey, Kyle, if you can kill your mic. About as far as getting life insurance, that would be an excellent strategy for some of the money. And I know you're going to enjoy some of the money if you give yourself a $300 raise. Life insurance isn't going to cost $300 a month. Or if you give yourself a $300 raise, saving for your 529 is not going to be $300. But we're thinking about something for some of that money. And for me, what I think would be important would be for you guys to consider saving money for college. Quick story. I'm really excited. My daughter, as you can see, she's looking forward to Penn State. She's going to be going to Penn State pretty soon. Now, quick story. She had said originally that she didn't want to go to Penn State, but apparently it turns out that she really did want to go to Penn State. And actually, I remember the day when she got the acceptance letter. She called me and said, "Hey, Dad, come home. I got a letter from Penn State, and it says congratulations on it." So after I finished up doing what I had to do, I got home, and we opened it up together as a family. We get excited. "Hey, welcome to Penn State." She's accepted to Penn State main campus. Now, she's running around all excited. Now, my wife and I are left with the letter that says Penn State tuition, room, and board is $31,000 a year. And so I was like, wow, now I get it. Now I see why people go out and get tremendous loans and everything, because if we didn't save up money and we watched Cheyenne be so excited about getting accepted to Penn State, how could we then tell her, honey, we can't afford to send you? So that's why as parents, we just would get huge student loans and just kind of figure it out. Well, what I want you guys to do is consider what we did. We started a 529 plan when she was 3 years old. And so what was exciting about that is that while the 529 plan was not able to pay for 100% of her college, we're happy to say that we have enough for at least 2 years of her college. And so that's very encouraging. And so for that matter, you might want to consider opening up a 529 plan. Okay. It has some state tax benefits. One of the things, when you put money into a 529 plan, it can go to save for college, so that when you're ready to use it for college, it's there. It also has some state tax benefits. If you put money into a 529 plan, then that money is tax deductible at the state of Pennsylvania. So that's a nice little benefit as well. And also the last thing, as part of the new tax law, the 529 plan, which used to only be available for college, it's now available to use to pay for maybe middle school, if you wanted to go to a private school for middle school, or for that matter, a private school. Like we had sent our daughters to Locust Grove Mennonite. If the 529 plan and the new enhanced feature of the 529 was available, we could have used some of the 529 plan to pay for some of the schooling at Locust Grove Mennonite when they were there. But that's part of the new enhanced 529 plan. You can use up to $10,000 for that. So again, you might want to really strongly consider, if you have kids, putting money into a 529 plan. So if we can just quickly summarize, I'll summarize some of the points, and then I'll let Kyle share a few points. And then we'll just put the finishing touches on. And again, Thank you guys so much for joining in this webinar. Feel free to share it and email the link. We want to educate people and let people know if you're a parent and you have kids, which of course will make you a parent, then what would happen is this new tax law gives you some incredible new tax benefits. Those tax benefits could allow you to give yourself a raise in 30 days by adjusting your W-4 so that your employer does not have to take out as much taxes. Because all they're doing is taking out taxes, sending it to the IRS, you do a tax return, and you get most of that money back. With the new tax law, you're probably going to get way more money back. And so as a result of that, you might want to think about giving yourself a raise by adjusting your take-home pay, by adjusting your W-4. And one of the things I thought would be a good idea with some of that money would be to consider a 529 plan. Now I'll turn it over to Kyle so he can kind of reiterate some points he wanted to mention, and then I think we'll be done.
Thanks, Fred. Yeah, once again, life insurance purchasing life insurance on your child is so critical. As I explained, I think the most important thing is it's really to financially protect you in the event that something comes down the road, and it gives you the time and resources to grieve and take care of what you need with your family. It's also going to provide tax deferred growth by giving you cash value and living benefits to be used. And I think most importantly too is you're just really protecting your insurability, your child's insurability down the road at a fixed rate, which is ultimately going to save you money. So I hope you take advantage of some of the things that we had educated you on by utilizing your raise. Like Fred said, you're going to spend some of it, but put the rest to good use. Fred, I think your mic's muted.
Thanks, Kyle. This new technology we're stringing together, my man just let me know my mic was muted. I just want to quickly say, I hope you guys understand that we, both Kyle and I, we have hearts of teachers. The most important thing for us in what we do is to teach and to educate. It would be a shame that if we did not spend some time letting people know in the most efficient way possible. And that's why we're hoping this webinar really works out in the most efficient way possible, that you guys have choices. You can save money, you can put more money into your pocket on a monthly basis. You know how difficult it would be to go to your boss and ask for a $100 or $150 raise? But what we hope to do is teach you that you can do that on your own by just understanding the tax law and how it can benefit you. Once you understand the tax law, if you're interested in putting some of this stuff in place, if you want to bring more money home and then subsequently make sure you protect your family and protect your children with adequate life insurance, please give us a call. If you want to take advantage of some of this, some of these opportunities and some of this education we've been sharing, and you want to start saving money for a 529 plan, please don't hesitate to give us a call. Our number's here. We're just excited and ready to help. Again, don't hesitate to share this webinar with others. The link will be made available to you and you can share it with others. They just have to register. But please make this go out and just share it with as many people as you can. Again, thank you so much for spending time with us on the webinar, and we'll look forward to being with you on upcoming webinars. Thank you.
Fred, I have one last thing just to share with everybody. Keep in mind, we both have Facebook pages. Please follow us on social media, whether it's Instagram or Facebook. Both Fred and I share some extraordinary beneficial information for whatever topic. So please check our pages, like it, and share it with others for continued support.
And Kyle, what's the best way they can find your Facebook page? Is that Life Insurance Mentor?
Yeah, my code name is the Life Insurance Mentor.
Awesome. Awesome.
Excellent.
So as soon as you can, everybody go out and like that page. I've listened to a lot of the videos that he shares. Again, as Heart of a Teacher, he has some great information on for life insurance. You can find me at Waller Tax and Financial Services. You can also find me at Waller Insurance Agency as well. Again, thank you so much, and we look forward to seeing you in future webinars. Thank you.